Hello, I'm Haider Malik, host of the Mehmi Financial Group podcast. Today's topic is buying out a family farm, asset buyout loans in Halifax. Acquiring full control of a generational operation can secure your legacy and accelerate strategic investments. But you need the right financing mix to cover equipment, land improvements, and working capital without draining cash flow. Here's how Halifax farmers can structure asset buyout loans. 1. Define your buyout scope. Asset versus entity. Focus on an pints asset purchase. Tractors, combines, grain bins, irrigation systems, and leasehold improvements to limit liability for any hidden debts. You'll negotiate fair market values for each item, leaving crop revenue contracts or entity liabilities with the seller. Valuation essentials. Engage a certified agricultural appraiser to value machinery by age, hours, and Saskatchewan's secondary market demand, and to assess land improvement costs, drainage tile, fence lines, livestock barns. 2. Financing components. 1. Senior asset loan. Coverage and term. Lenders typically finance 60 to 75% of aggregated asset value over 5 to 7 years at prime plus 1%, 1.5%. Collateral. The financed assets themselves serve as security. No down payment may be required if advance rates are high. Amortization and rate. Fixed or variable structures available. Consider fixing rates if you expect prime to rise. 2. Seller financing. Mechanics. The retiring family member carries a note for 10-20% of the buyout price, repaid over 3 to 5 years at a negotiated spread, e.g. prime plus 0.5%. Benefits. Reduces your immediate cash need and aligns the seller's interests with your farm's continued success. 3. Equipment-backed revolver. Structure. A revolving line secured by remaining farm equipment, up to 70% advance, funds working capital needs like seed, fertilizer, and seasonal labor. Flexibility. Draw and repay as crop cycles demand. Interest accrues only on used balances. 4. Equity injection. Your contribution. A down payment of 10-20% of the total buyout cost via personal funds or co-investors signals skin in the game, improving lender leverage and potentially lowering rates. 3. Strengthening your application. 1. Pro forma cash flows. Model a 5-year forecast of revenues, input costs, debt service, and reserves for maintenance. Target at least 1.25x debt service coverage on senior loans. 2. Asset condition and usage logs. Provide maintenance records, hour meter logs, and calibration certificates for each machine to support appraised values and advance rates. 3. Operational transition plan. Outline how you'll integrate operations, staff retention, crop rotation continuity, and any planned efficiency investments so lenders see minimal execution risk. 4. Negotiating key terms. Interest-only start. Secure 6-12 months of interest-only payments on the senior loan to ease cash flow during equipment turnover and harvest. Covenant structure. Favor collateral value tests, e.g., equipment LTV ratios over rigid revenue coverage ratios, accommodating crop price swings. Prepayment and renewal. Ensure no penalties for early principal reductions when grain sales exceed forecasts, and the option to top up or refinance the revolver without full re-underwriting. 5. Execution roadmap. 1. Letter of intent. Lock in headline terms, purchase price, financing split, timelines, and exclusivity. 2. Due diligence, 30 days. Finalize appraisals, verify equipment titles, complete environmental and site inspections for land improvements. 3. Financing commitments. Secure term sheets from your primary bank, a second regional lender, and if needed, an ag equipment captive for competitive quotes. 4. Closing and drawdown, 60 days. Sign senior loan, seller note, and revolver documents. Disburse funds to the seller, transfer asset titles, and establish your new credit line. 3 action steps. 1. Inventory and appraise. List all farm assets targeted for buyout and arrange preliminary valuations from an ag specialist appraiser. 2. Build your case. Compile 2 years of financials, maintenance logs, and your pro forma cash flow model into a concise financing presentation. 3. Solicit and compare. Request competing proposals for senior asset loans, seller financing terms, and revolver structures, then choose the mix that delivers the lowest all-in cost with maximum flexibility. By combining a senior asset loan, seller financing, a working capital revolver, and your own equity, backed by solid valuation, cash flow modeling, and flexible covenants, you'll execute a family farm buyout in Halifax confidently, preserve liquidity for operations, and position your farm for sustainable growth. I'm Haider Malik. Thanks for listening, and here's to carrying your family's legacy forward.